Assalamu alaikum friends. Welcome to question number 32 of SBR Kaplan revision kit, which is also a question, the fourth question in December 2018. So fourth question, the nature of the fourth question is that mostly it includes current issues like conceptual framework or some management commentary or exposure draft, things like that. So it includes more like current issues and all is there in question number 4. So let us read what is there in A. Before we read ABC, let us see the overall requirements. Okay, so with reference to the above information, explain to the investor the nature of the accounting for taxation. Okay, this is for part B. Okay, part A. So part A and part B, these are the two requirements. The IFRS part A requirement, the first one is about IFRS practice statement management commentary. Discuss briefly the arguments for and against. So 2 marks for and 2 marks against. As a non-binding framework or as an IFRS standard. Okay, whether it should be a IFRS standard or it should be a non-binding framework. See, IFRS standards, they are binding. You are bound by that. Whatever is there in IFRS standards, one has to follow it. You have no say over it. But if it's a non-binding agreement, agreements are not binding. If you don't follow it, no one is going to penalize you for it. Because it's not binding. So you have to give reasons for and against whether it should be a non-binding or an IFRS standard. The IFRS practice statement management commentary, okay, which is worth 4 marks. So 2 marks for and 2 marks against. Next, discuss how the qualitative characteristics of understandability, relevance, and comparability should be applied to the preparation of the management commentary. This is about management commentary. Make sure that you know about management commentary. Most of the students, they don't, and they find this topic hard. Qualitative characteristics, already 3 qualitative characteristics they have given you. So these are the 3 characteristics that you have to use. You don't have to mention other than these 3 characteristics. One is understandability, the other one is relevance, and the other one is comparability. Okay, the IFRS practice. Okay, so now I'm going to read the case study. The IFRS practice statement management commentary provides a broad non-binding framework for the presentation of the management commentary, which relates to financial statements which have been prepared in accordance with IFRS standards. Management commentary is within the scope of conceptual framework, and therefore the qualitative characteristics will be applied to both financial statements as well as the management commentary. Okay, simple. B is more about tax and all. You have to use your IAS 12 deferred tax. So that, let's not go to it, that it's more technical. So let us first finish with requirement A, because this is most of the doubt people have is in part A. I feel that's what I feel, because it's an open-ended questions and people can write it in any way, but how to write, because it's like a theory questions, because theory questions all the students find it tough. Calculations you will somehow do it. That much trust I have on you people. So yeah, if you read the key tips from the examiner, you'll be quite shocked, because this is not an easy question. Many students who said found this question difficult, right? Because there are some tricky elements, right? But if you see part A, it's really straightforward, because they are asking about management commentary, and this is a current issue. You see, many students do not study this area of the syllabus properly. They just go or they read it, or some they don't. The very so-called genius or over genius, I should say, they don't even go through this, thinking that is current issue. They will somehow make some answers. It does not happen like that. You just cannot make out points like that. It will never happen to you, because on the day of the exam, trust me, you'll be stressed out. Even while you're practicing also, it's not just the standards that you have to practice. Current issue part also you have to practice. Conceptual framework also you have to practice. Every SBR exam, current issues you will face. Mostly question number 4 is on current issues. You will face current issues. You cannot run away from it. What about part B? Even though we didn't read, but let's see what they told here. This appears tricky, but actually offers some very easy sources of marks. For example, all students sitting SBR should be able to provide an explanation of accounting for deferred taxation, isn't it? We know how it is. For deferred tax liability, for deferred tax asset, these things you should be able to do. Make sure that you concentrate on the parts of the question that you're most comfortable with. So these two are not related. You can answer either part B first or either A first. So let me start with A, management commentary. Okay. Remember, within the SBR syllabus, this comes as a current issue. Okay. And current issue will come in every SBR exam. So first one is topic is management commentary. 4 points. 2 points for, 2 points against. Okay. So if you see here, one is arguments against non-binding, arguments for non-binding. Now, since this is an open-ended question, no numbers, fully theory, if you will see that generally these answers are very long, longer than it should be. Okay, but what you have to stick is just write 2 points for, 2 points against. That's it. Once you are done, that's it. You can go to the next question, but we definitely will read through the answer. This is just they are giving some introduction, like okay, the first paragraph. They are not. It's not against or for. Let's see what they have written here, which you don't have to write all this because you can directly just start saying from arguments for or against. That's what the requirements also asked you, but for your understanding purpose they have given you this paragraph also, just this paragraph. Okay, we'll just read it. IFRS practice statement management committee provides a broad non-binding framework for the they provide a broad number one and non-binding framework for the presentation of the management commentary. The practice statement is not a it is not an IFRS standard. Okay, the practice statement. Consequently, entities applying IFRS standards are not required to comply with the ones who are applying. They are not required to comply with the practice statement unless specifically required by their jurisdiction. Okay. Furthermore, non-compliance with practice statement will not prevent an entity's financial statements from complying with IFRS standards. Just because you have complied with practice statement, you cannot say I will not comply with IFRS standard. No, IFRS standards, they are binding. You have to comply. Even if you have not complied with practice statement, it's fine. But IFRS standards you have to comply with. Okay, this thing is just for understanding what is this IFRS practice statement management commentary is all about. Okay, this you should not write in your answer. What you should write is the arguments for and against. 2 points, 2 points here, 2 points there. That's enough. Okay, and if you see what the tutorial note says, you should be able to generate some points here using common sense. So common sense is something that you should be using throughout all the questions. In fact, sometimes where especially in questions where you are stuck, open-ended questions like this, if you're stuck, use common sense there. If your textbook knowledge is not enough, nothing is coming in your mind, then use your common sense and go ahead, but don't get stuck anywhere. Okay, because this is question number 4 and by the time you come here you are half exhausted. Trust me, you're half exhausted, you won't be thinking fresh, it's hard to think, you'll be running behind time, maybe you have left some questions behind, you'll be thinking about them. So it happens, don't panic, use just keep using common sense and go ahead. Okay. Okay, so mandatory standard. This is arguments against non-binding. Why it should not be non-binding? That means why IFRS standard. A mandatory standard is more likely to guarantee a consistent application of its principles and practice. So this is one point. Okay, this one point if you have written, that's enough. But they have explained it further. Let's see. If you want, if you have time, explain it further. It's okay. But the explanation should be in 1 or 2 lines. That's it. It should not be too much because it's just for 4 marks. Okay. Some entities will not produce management commentary because its application is non-mandatory. But the moment you write this, it's understood. Okay. Because it's non-mandatory, not everyone will produce. But if it was a mandatory, everyone will produce and they will stick to the same principle, consistent. It's like they are giving disadvantages of non-binding approach. Okay. Next, so this one point you will get here for consistent application. Number 2, it can therefore be argued that both objective of enhancing the comparability of financial information will not be achieved unless management commentary is mandatory. Unless you make it mandatory, you cannot compare. So the number 2 is comparability. Your 2 points are over. That means you are saying it should be arguments against non-binding means you are saying it should be binding because consistent and comparative. If it's binding, you can compare easily. If it's not binding, one will be following this one will not be following, it becomes difficult. Now let us go to this one. Arguments for non-binding. Why it should be non-binding? Okay, greater flexibility. But still, this can be a drawback. So you see, every advantage has a disadvantage associated with it. Okay, but when you're writing it, make sure that you decide beforehand that what are you going to write exactly. What these are the advantages, these are the disadvantages. Don't just write and then think. First thing, what are the advantages and disadvantages you are going to write? How many points? If it's 2 points, how I'm going to explain? How many paragraphs? And then write. Okay. It's a drawback because it can lead to the disclosure of more relevant information. It can also lead, sorry, it could also lead to the disclosure of more relevant information. Okay. So definitely this answer is pretty big enough. You don't have to write this much if you see. It's big, right? For 4 marks is very big. Only 2 points you have to write. But just we'll quickly go through this. Oh, it is difficult to create a standard on the MC. MC means multinational companies, okay? Which is sufficiently detailed to cover the business models of every entity or be consistent with all the IFRS heads. It's hard for them. So this is again, so this is one point. Difficult to create a standard on MNC, isn't it? It's hard because every multinational company, they are huge companies. Most of their business transactions, they might not have a specific IFRS standard for that. It's hard to deal, right? And not every company is same also. It's difficult to cover everything for them. So in that, it is better to use non-binding approach. Next, so this thing only they have developed and they are talking about it all this. The practice statement allows companies to adopt the information. You are talking good things about practice statement, okay, rather than being an IFRS standard. So practice statement allows companies to adapt the information provided. You can adapt the information provided to a particular aspect of their business. Okay, the same thing only they're explaining in detail here. So this flexible approach, okay, could help generate more meaningful disclosure about resources, risk, and relationships. That means if you're flexible, you can provide more meaningful information, which can affect an entity's value and how these resources are managed. It provides management with an opportunity to add context to the published. See, all these things they're explaining, all these things, if you want, you can cut down on this. You don't have to explain all these things. The moment you say it's flexible approach, meaningful disclosure, it's enough. You will get your points. Okay. So it provides management with an opportunity to add context to the published financial information and to explain their future strategy objectives without being restricted by the constraints of a standard. This many lines you don't have to explain. If you can explain this in 1 or 2 lines, very good. That's what is expected from you. Do what is expected from you. Don't do what is not expected from you. Okay. Next. So that's first point. We have to look for one more advantage of non-binding. Some jurisdictions take little notice of non-mandatory guidance. But the practice statement provides the local regulators with a framework to develop more authoritative requirements. Okay. Very few say take care of the non-mandatory guidance. Not much. But practice statement, what does practice statement do? They provide local regulators with a framework to develop more authoritative requirements. So this is like a second point you can give. You see, each point should be given in different paragraphs. Don't write 2 points in one paragraph. 1 point, one paragraph. First point talked about flexibility, and it was I think 6-7 lines. Not needed. Second one is just 3 lines. Okay, keep it short and sweet. You might be having 5 points to write, but always choose the points which you can write faster also and which is short. It saves your time also. Don't write a point which is very difficult for you to explain also. You will find tough. If you have a very good knowledge, if your common sense is very good, like you're using it, it's working. Sometimes common sense also does not work. You are like, I know it happens. You get freeze and all, but if it works, then you have to take care of these things also. Wherever you can maximize, I mean, manage your time, do it. Write short points and easy points, points which is very easy for you to explain also where you have the knowledge. Okay, write those points. So if the MC were a full IFRS standard, this is the third point they are giving. This is not needed. Okay, because already two you have given. So if the MNC were a full IFRS standard, the integration of management commentaries and the information produced in accordance with IFRS could be challenged on technical grounds as well as its practical merits, right? If it's full IFRS, taking two things and integrating it becomes very difficult. One is management commentary, the other one is IFRS. So these are some 3 points, but you just have to write any two of it. Next, we are going to the three things how we can apply this. Okay, so it's always a good technique that you always keep revisiting your requirements. Okay, so I know that my first requirement I have answered, just put a tick mark. Second, discuss how this should be applied to the preparation of the management commentary. How can you apply this when you're making management accounting? For example, understand, how can you make it more understandable? How can you make it more relevant? How can you make it more comparable? Okay, so now each point, different subheading you have to use, different paragraphs also. Understandability, let's start with understandability. The conceptual framework states that the financial information, okay, these features are there in where conceptual framework. So you have to make a reference to the conceptual framework here and there, all the 3 points. The conceptual framework states that the financial information should be readily understandable. MC should therefore be written in plain language and a style appropriate to user needs. Keep it simple. That means management commentary that you are doing, it should be kept very simple. Don't use technical jargons which the users cannot understand. The form and the content. Okay, so this is the first point which talks about plain language. Second, let's see what they have written, because I think it's for 5 marks. Yes. So the form and the content of the MC will vary between entities. We know that. Sorry, MC is management commentary. I Okay, the form and the content of MC will vary between entities. I told multinational companies, right? That's I got confused because it's MNC. I'm sorry, guys. Previously also I made that mistake. MS is management country, because just when I'm reading the sentence here, it's not making sense that it's a but anyways, it's good that I came to know my mistake. And the form and the content of this one will vary. Next is, we know the form and the content, it's not same, they don't have a standard format. It varies reflecting the nature of their business, their strategies adopted, regulatory environment in which they operate. All these are different. Whatever the form and the content, users should be able to locate the information relevant to their needs. This is the second point. So second marks you will get from here. Whatever the form of this one, users, okay, they should be able to locate information very easily, whichever is relevant for them. Next, we are going to the towards relevance. So total 5 marks. Now it's up to you. How are you going to divide those 5 marks? Definitely, if you're writing 1 point each, you will only get 3 points. So somewhere you have to write more points. Okay, you have to balance it out. Like here, understandability, 2 marks you'll be getting. Relevance. So relevance, I can see we are writing more. That means that shows more points we'll be getting for relevance. Begin by defining relevance as per. So you start by defining under conceptual framework what each of this means: understandability, comparability, and relevance. Understandability and comparability by the word itself, you know what it means. It is a relevance. You have to explain it in a proper way using the language that conceptual framework uses. Don't say that relevance means information which is relevant. I mean, come on, it's so okay. Information has the quality of relevance when it has the capacity to influence the economic decision of users by helping them evaluate past, present, and future events, or confirming, correcting their past evaluations. You can influence the user to make decisions. In short, that is known as relevance. Relevant financial information has two things. One is predictive, one is confirmative value, or both. Okay, that means looking at that, you should be able to predict your future, or it confirms that this is what happened in the past, or both. Okay. So the onus is on management to determine what information is important enough to be included in the management commentary. Now it is up to the management. They have to decide what has to be included in the MNC to enable users to understand the financial statements and meet the objective. If the entity provides too much of information, you should not produce too much, you should not give too less also. Too much, then it reduces relevance and also understandability also. So 1 mark you will get here. If material events or uncertainties are not disclosed, then users may have insufficient information to meet their needs. If it's material, you have to disclose. Next, however, unnecessary detail may hide the important information, especially if entities adopt a boilerplate approach. If management presents too much information, for example, all the risk all that is that an organization is facing, this will conflict with the relevance objective. There is no single optimal number of disclosure, right? Nowhere it will tell you that provide this many disclosures only. This is the optimal level. There is no optimal level like that. You have to balance. It's up to you. Did you see this part is a little bit tough compared to understandability in writing? Okay, but it's useful to convey the relevant importance is a okay to convey the relative importance in a meaningful way. So when you're writing, write that it should not be too much or too less. Keep it. You have to balance it out. Okay, balance. Comparability. This is easy. This should be easy for you. Okay, I think 1 mark only will get for this or two, depending on how much you have wrote for the other two parts. Okay, so you have to compare. Compare means you should be able to compare. Okay, you have to understand the similarity and the differences. Okay, you have to compare over time or between entities. But here comparability could be problem for a management commentary. Why? How? Because it's not financial figure that you can compare. It reflects what perspective. Management commentary is like it looks out in the perspectives of management and the circumstance of the individual entities. So this is something hard. Every entity is different. You cannot compare it. And perspectives of management are also different. It's hard to compare them. How can you compare them? How can you say this perspective is better, that perspective is better? Okay. Does entities in the same industry, even industry in industries in the same, sorry, entities in the same industries might have different perceptions of what is important and what is not, and how they measure and report it. They might have different opinion on how to define and calculate non-financial measures and financial measure, okay, which are not produced in accordance with IFRS standard. So there are some inconsistencies in the definition and calculation also. But how can you make it more comparable? That's what the requirement asks. This was some issues that you cannot compare. It's not enough to give write this. It is sometimes suggested that effectiveness of the overall report may be enhanced by strengthening the links between financial statements and the management commentary. You straighten the link. However, such suggestions raise concerns about maintaining a clear distinction between the financial statement information and other information. You have to maintain a clear distinction. What is the financial statement information and what are other information? So an entity should ensure consistency in terms of wording. Wording you can keep consistent, or definition or the segment disclosure. These things you can keep it similar between what financial statements and the management commentary to improve the understandability of the financial performance. Then it becomes easy for you to compare also. Now let us go to part B. So A is over. Now remember that this is just one way of answering. A you can answer in different ways. You might have some different answers which is not there in the answer. In that case, make sure that you get it marked by someone. If you are learning through online, some sites, for example, Learn Signal is one good website. If you are learning, then make sure that you send them your mocks and get the feedback. Or if you are learning under any tutor, make them mark it, because don't self mark, especially when the answer is not there in the marking scheme. I would say that's a very risky strategy to apply, because you will be thinking that you are right, but actually you might be wrong. You might be off track. How will you know it? So make sure that you give to some very reliable person to market on behalf of you, so that he or she will give you some honest feedback. Now let us go to part B. Part B is an area where more things has to be done, because it is for 14 marks, and 2 professional marks is in your section A, which is for ethics, and the other 2 professional marks are in your section B, question number 4, the last question. Okay, let us see the requirement before I go to the case study, because I always read requirements before I read the case study. So with reference to the above information, explain to the investor the nature of accounting for taxation in the financial statements. Your answer should explain all these things. Your answer should explain. One is tax reconciliation. Discuss the implications of what? Both current and future tax rate. Provide an explanation of accounting for deferred taxation in accordance with relevant IFRS standard, that is IAS 12. So there are too many things you have to do. One is tax reconciliation, the other one is current and future tax rates, the other one is explanation of deferred tax. 3 things. Okay, and also explain to the investor. 4. Let us read. Holds Group is preparing its financial statements for the year ended 30th November 2007. The directors of Hall have been asked by an investor to explain the accounting for taxation and financial statements. The group operates in several tax jurisdictions and is subject to annual tax audits, which can result in amendments to the amount of tax to be paid. All these things is very quickly you can read. Okay, don't spend so much of time. The profit from continuing operation was 300. It's given here. And the reported tax charge was 87. Okay, here it's given 87. The investor was confused as to why the tax charge was not the tax rate multiplied by the profit from continuing operations. What was the tax charge? We'll see later. Okay, why it is not on this? Because if we see 87, okay, it does not look like, because usually when you are given the tax, it will might be 30%, 20%. So if you apply 30 or 20% on this 300, you will not get 87. You will get a round up figure. So looking at the tax charge and looking at the profit, you can see that it's not based on the percentage on this profit from continuing operation. That's what they are concerned. They're confused why it's not like that. Okay. The debtors have prepared a reconciliation of the notional tax charge on profits as compared with actual tax charge. So they have prepared a reconciliation. Okay. Let's see what are the things they have taken. So profit before taxation, then they have done some adjustments. Notional charge at local corporation tax of 22%. 22 of 300, which is 66. So differences in overseas tax rate, 10%. Tax relating to non-taxable gains on disposal of business, tax related to impairment of brands, other tax adjustments. Okay. So the amount of income tax paid as shown in the statement of cash flows. Income tax paid in the statement of cash flow is 95 million, but there is no current explanation of the tax effect of the above items in the financial statements. Above items means all these items. This. There is no explanation on this. Next. The tax applicable to Halls for the year ended 30th November is 22%. That's given. There is a proposal in the local tax legislation that the new tax rate of 25% will apply from 1st of Jan 2008. In the country where Hall is domiciled, the tax laws and rate changes are enacted when the government approves the legislation. The government approved the legislation on 12th November 2007. That's before this date, right? The current weighted average tax rate for the group is 27%. Hall does not currently, so this is a very tricky question and confusing because so many tax rates, 25%, 22%, 27%. Hall does not currently disclose his opinion of, he does not disclose of how the tax rate may alter in the future. But the government is likely to change with the result that the new government will almost certainly increase the corporate tax rate. At 30th November 2007, Hall has deductible temporary differences of 4.5. Remember, it's deductible. So this is in bracket. Not taxable, which are exposed to reserves in the next year. In addition, Hall also has taxable. He also has a taxable temporary difference of 5 million, which relates to the same taxable company and the tax authority. Hall expects 3 million of total taxable temporary difference to reverse in 2008 and the remaining 2 million to reserve in 2009. Prior to the current year, that means before the current year, Hall has made significant losses. Okay. This is a tricky question actually, because most of the students are confused how to start this question, how to end this question, and what to write in the middle part. So don't worry, that's my job. My job is to guide you. Okay. So you start with the current tax first. Okay. Then you can start in the order the requirement asked you for. They asked for tax reconciliation. Okay. Then they asked for the tax rates, impact of the current and the future tax rates. Then they asked you for the deferred taxation. Okay. Then application of the deferred tax rules to Halls. Okay. This also they have asked. So it's a very long answer, and you can expect also because it's for 14 marks, but definitely not this long, much shorter than this, but it will be a long answer for sure. So first you start with the current tax. You first need to know what's currently happening before you talk about past or future or tax reconciliation or deferred tax or anything. Okay. So current tax is based on what? You are writing it. It is based on taxable profit for the year. And what is taxable profit? Taxable profit is different from accounting profit. Remember to talk about these two things. One is taxable profit versus accounting profit. They are different. Why? Due to temporary differences. It's like all your knowledge of IAS 12 you need to apply here. This question is that type of question. Okay. Due to temporary differences between accounting and tax treatments. That means the tax persons, okay, the tax authorities who do this, they do it in a different way and I do it in a different way. Okay. When I'm preparing my accounts, I calculate it in a different way. That's why because of that, there's some difference, but that difference is temporary. In the long term, there will be no difference. It will be wiped out. That's why the name is temporary difference. So because of that temporary difference, accounting profit is something taxable profit. That means profit on which I can calculate tax is different. Because tax authorities, what they do, they allow some items and they don't allow some items to be deducted. So that's the difference we have. And because of that difference, they are different. Okay. And due to items which are never taxable or tax deductible. Some are never taxable, some are tax deductible. The difference could come from this also. Tax benefits such as tax credits are not recognized unless it is probable that tax provisions are sustainable. We have to talk about this. Tax positions are sustainable. What does it mean? Tax benefit. We are referring to deferred tax asset. We recognize it what? But this is not about deferred tax. This is about current tax we are talking about. Deferred tax comes later at the end. Okay. So even for current tax also, when it's that means we are not paying tax. It's a negative balance. Okay. In that case, what should you do? You will be offsetting it in the future when you're having taxable profit. Let's say current year you are having losses. So you are having losses means you don't have to pay a tax. It's a tax benefit. This benefit you'll be receiving in the future. How? You will be able to reduce this tax from your taxable profit in the future. Because tax you're not paying in the current year, you have to pay in the future year. But definitely that amount you can reduce it from your taxable profit. Okay, so you have to recognize that tax benefit only in the future if your tax positions are sustainable. That means you are having a taxable profit in the future. Then you recognize tax benefit or tax credit. Tax benefit is one form of tax credit only. Okay. Now we are referring this to the case study. We are bringing this to the group. So the group is required to estimate the corporation tax. Remember, it's a corporate tax which they have to estimate because it's a group. Companies always pay corporation tax, not income tax. So they have to estimate the corporate tax in each of the many jurisdictions in which it operates. In all the jurisdictions, they have to estimate their tax because tax rates are different in the jurisdictions. So the group is subject to tax audits in many jurisdictions. As a result, group may be required to make an adjustments in a subsequent period. They have to make some adjustments, which could have a material impact on the group's profit for the year. Now we are going to the tax reconciliation. I hope this is easy. Nothing hard there. Coming to the tax reconciliation. Discuss the tax reconciliation, what it shows and what it has to show and why it is useful. These things you have to talk in the tax reconciliation. Okay. First of all, tell the importance. Why tax reconciliation is important. It is important for understanding the tax charge reported in the financial statements. And why? Number one is that. Number two is why the effective tax rate differs from the statutory rate. In tax reconciliation, you will understand. Basically you are giving the advantages of tax reconciliation and what it includes. Okay, its users and all. So most companies will reconcile the group's annual tax expense, right? Whatever your annual tax expense, because it's an expense, you will reconcile this with the statutory rate in the country in which the parent is based. That's why they will do it. So hence the rate of 22% is used in the tax reconciliation. Again, we'll go back to the case study to see why 22% is rate, because it's very likely that you will forget what is this 22%. It is the tax rate that is applicable to Holls, 22%. Okay, so it makes sense that you are using 22%, which is the tax rate applicable for Holls. Okay, so you're explaining that, hence that's why this 22% is used, because they didn't give any explanation. They have just put it 22%. Now you are giving explanations why that 22% of tax rate they have used. Okay, it is important that reconciliation explains the reasons for the differences between effective rate and statutory rate. You have to explain difference. Okay, remember to state the obvious. Sometimes something looks very obvious. You might be thinking, oh, the examiner knows it, it's there. No, you still have to state it. The other category is vague. They didn't explain what are those other category, right? They have that other category there and does not provide useful information. So this does not provide useful information. Okay, that's what you have to explain in your answer now. There should be a minimal use when you're doing tax reconciliation. We don't put this other category. Very rarely. Use has to be very minimal, because when you're putting other category, you have to put another disclosure explaining those other categories. What are the things in under the other categories? But they didn't provide. So if you are not providing it, don't use it in the tax reconciliation. We are still in the tax reconciliation, guys. Tax reconciliation means we are explaining all the things here, all the things we need to explain in your answer. So we finished this. Okay, then we have to talk about this, then we have to talk about this, then we have to talk about this and this. So now we are here, other tax adjustments. So it's not very clear how this 14. Okay, we have to talk about other things as well. Just kind of, okay. So please make sure that you write the numbers also. Okay, in this case, the other category is significant, but in this case, it is significant. It's not very small. Usually, other categories are very small amount, so we don't use it also. If you show it also, it won't make a huge impact. If you don't show it also, not, but this is significant, 14 million. And there is no explanation of what other, no explanation is there what other constitutes. So this makes it harder for the investors to predict the group's tax expense in future period. Next. Now we are going to the next paragraph. Just see, every paragraph we have different things. Okay. Here we talked about 22% rate. We justified it. That okay. If we are justified or not justified. But paragraphs are different. Here we are talking about other expenses. Other tax expenses. Okay. Now in the next paragraph we are talking about what? What are we talking about? One-off and unusual items. Okay. In this we'll see what else is included. So one-off and unusual items can have a significant effect on the effective tax rate. But financial statements and disclosure notes rarely include a detailed discussion of them, right? Even though it can have a significant impact, but rarely they put this because it's one-off. They feel that they don't have to provide detailed discussion on it. What are some examples from the case study? Take examples. One is brand impairment. Remember, there's a tax on brand impairment. Brand impairment is something which does not happen frequently. Very unusual and one-off. And the other one is disposal of business. You don't keep on disposing businesses every now and then. So if you are doing this, you should be explained to investors, because they are material items. If you look at the figure also, there you can see. Sometimes it's not about the figure, so don't, if you have to say whether it's material or not, go by your common sense also. Not everything is by the figure. Usually if it's a one-off or unusual item, they are usually material items. Okay, unusual items you don't do for small amounts. So the explanation should include any potential reversal of the treatment. If you are reversing it, For example, you have recognized a tax on the impairment. Now that impairment is not there anymore. Let's say you have came to know after 2 years that the condition that exists, or you predicted that there will be an impairment. Actually, there's not an impairment. The condition of the value of the brand improved. So now you are reversing the impairment. If you are reversing the impairment, the tax also changes. So for that also you have to give explanation if you are doing such a reversal. Okay, coming to the last paragraph. Some profits recognized in the financial statements are not taxable. Not every profit is taxable. In some jurisdictions, such as gain on disposal, when you are selling a business, the gain you are getting, that is not taxable. Okay. Also, the impairment losses, they do not obtain tax relief. See, impairment losses. Okay, whenever it's a loss, you cannot say you are going to pay tax. Okay, that's why we are saying we are using the word tax relief. If gains are not taxable, impairment losses also you will not get tax relief. Okay. So these issues should be explained to investors so that they understand the impact on the group's effective tax rate. Now we are moving towards tax rate. Okay. Because tax rate is very important. Investors need this information to make investment decisions. And also you can predict the entity's cash flows also based on the tax rates. Why? Because tax paid is a very significant annual cash flow. We know that tax is very huge amount. That's why investors, when they invest, they look at the tax rates. It's a huge cash amount of your cash outflows are in the tax. And if you are having big amount of loans, then definitely interest is also there. But tax is something which you cannot avoid. Okay, you have an obligation to pay the tax. And also, even if your company is making losses, then you will not have to pay tax that year, but in the future you can, if you are having profit, that you will deduct it, and then that loss you can carry forward, deduct, and then you have to pay the tax. So for that also, whether you'll be making loss or you can carry forward it not, tax rate is very important. You should know the tax rate. Okay, it's very important. The different tax rate is therefore very important. This is in the tutorial note. That means these things are only what is explained in your answer. Tutorial note gives you a snapshot of what is being described in the answer. Okay, now we know what is the scenario that the group is operating in multiple countries. You have to mention these points, because if it's not operating in multiple countries, then if you're writing different tax rates, it does not make sense. So first you need to mention that it operates in multiple countries. Okay, so the actual tax rates that is applicable to profits in those countries are different from the local tax rate. Definitely. Overseas tax rates are higher than local rates. Hence the increase in taxation charge of 10 million. Exactly, this was given in the reconciliation. That's what you are explaining now. Okay, and most of the things, if you see, these are not from your textbook. You will not get them in your deferred tax IS 12. No, this comes from common sense that it will be different. Obviously it will be different, and also overseas tax rates, it will be higher than the local. That's why that increase in tax charge. So all these things is there. Common sense is not there in your textbook or something. Local rate is different from the weighted average. Weighted average 27%, local rate is something else. It's different of the group. Based on different jurisdiction in which it operates, investors may feel that using the weighted tax rate in the reconciliation gives a more meaningful number using this one. That's what investors feel. Why? Because it is a better estimate of the tax rate of the group that group expects to pay over the long term. So investors will wish to understand that the company's expected long-term sustainable tax rate, so they can prepare their cash flows or profit focused. Okay, they will definitely want to understand what are their long-term sustainable tax rates, any investor, because then they can prepare their cash flows and or prepare profit focused. Okay, another thing which is very important is the sustainability of the tax rate. whether tax rate remains sustainable or it keeps changing up and down very frequently, because then it becomes very volatile. It can affect your cash flows also over the long term, whether it's sustainable or not. It's very important because the rate high or low compared to other jurisdiction. An adjustment can be made to an investor's financial model for a long-term sustainable rate, but not for a volatile rate. Okay? If it's a long-term sustainable rate, it's easy to make adjustments. You can make some adjustments, but not for volatile rate, you cannot make adjustments because there is no uncertainty. Which rate, this rate, that rate, which rate to apply. And volatility, when the rates are different, it becomes more volatile, hence it becomes very difficult, harder to predict the cash flow in the future. Okay, so for modeling purposes and understanding of the actual cash tax paid is critical. Okay, what is the actual amount of cash that is paid, actual amount of tax that is paid in cash, and the cash paid of 95 million can be found in the statement of cash flow, isn't it? 95 million is a very big amount. Okay, now we are coming towards deferred taxation. Finally, the question asked, what is the accounting treatment of deferred taxation? So if you see, this answer is quite long. You need to break this answer, because you need to break down this answer and then study. Even while you're writing also, even while you're learning also. As it is, it looks very big and complicated. Okay. So we have to talk about temporary difference. We start with this term. The provision for deferred tax is made on this temporary difference only we calculate tax, deferred tax. Okay. And how do you calculate temporary difference? Carrying amount of assets or liabilities minus. Okay, this is from financial reporting purpose, and their value for tax purpose. That means tax base. You minus this. That is your temporary difference. Now, the amount of deferred tax reflects the expected recoverable amount and is based on the expected manner of recovery or settlement of the carrying amount of assets and liabilities, using the basis of taxation enacted or substantively enacted by the financial statement date. Okay. Next, we are talking about deferred tax asset. Deferred tax asset we do not recognize. They are not recognized. In which condition they are not recognized? When it is more likely than not that the assets will not be realized in the future. That means in the future you are not expecting profit. There will be no taxable profit in the future to utilize your loss against. Then you cannot recognize a deferred tax asset. Evaluation of deferred tax assets recoverability requires judgments. You have to use judgments in this area, whether you have to refer deferred tax or not, whether in the future you expect to get a taxable profit or not, to be made regarding the availability of the future taxable income. Next, management assess the available evidence to estimate if the sufficient future taxable income will be generated to use the existing deferred tax asset. You have to see the evidence. They'll be assessing the evidence. A significant piece of objective negative evidence evaluated. Okay, what was it? There's one negative evidence. That means they are, which are saying that you cannot, in this case, recognize a deferred tax asset. What is that negative evidence? Loss incurred in the period prior to the period ended 30th November 2007. They clearly told that there's a loss. So because of that one evidence, it's a negative evidence, and it's an objective evidence. Okay, not something based on some estimation or not, because it has already happened. So facts are there, financial statements are there, so it's objective evidence. So this limits the ability to consider other subjective evidence. Once your objective evidence is weak, it's negative, there is no use of focusing or estimating in the future that this will happen, because those are subjective evidence. Remember guys, objective evidence always, it will overweigh your subjective evidence. The power of objective evidence is always more. Preference is always given first to the objective, then to the subjective evidence. Okay, such as projections for future growth. Next, deferred tax are one of the most difficult areas of the financial statements for investors to understand. It's true. That's why there needs to be a clear explanation of the deferred tax balance and also the analysis of the expected timing of the reversal also. This would help investors see the time period over which the deferred tax assets arising from losses might reverse, right? So it would be helpful if the company provide a breakdown of which reversals would have a cash tax impact and which would not. Not every reversal will have an cash tax impact, only some that you have to show the breakdown because we are talking from the investor's point of view. Which type of information regarding to tax will be helpful for investors. That's what we are always talking, that if you provide this, it will be helpful for investors. If you do not provide this, this will not be helpful for investors. That's why we're talking about investors. Okay. Application of deferred tax rules to Halts. Before I go this again, let me take you through the requirements. Okay. Explain to the investor. You have to explain to the investor with reference to the above information the nature of the accounting taxation in financial statements. So they have clearly told in your answer what are the things you have to include. One is tax reconciliation that we finished. Implications for the current and the future tax rates that also we told. Explanation of accounting for deferred taxation in accordance with relevant IFRS standard. Right? So somewhat we have explained. Now we are left with the last part. We are relating it to the case study. And that's it. That's the last part. Application of deferred tax rules to Halls. Okay. Now, all this while you are being given the knowledge part of it. Now is the time for you to refer this to the case study. So as the proposed tax law was approved, proposed means in the future you are going to have some tax rate that has been approved before, but it is considered to be enacted. Therefore, the rate of 25% should be used because this 25% they told in the future they're going to increase it to 25%, but it was already approved before it in 2007 only, before 30th November 2007. Therefore, this rate you have to use. Okay, so this rate should be used to calculate what? Deferred tax liability associated with the relevant items which affects the deferred taxation. If an item affects the deferred taxation, then only you have to calculate deferred tax liability, otherwise no. So now you can calculate, now is the calculation of deferred tax balances. Okay, this shall be easier now. So at this date, always mention the date because every date tax rates are different. What do they have? They have a deductible temporary difference. Why deductible? Your liabilities are more than assets. It was 4.5. And these are expected to reverse in the next year. That means in the next year it will change because you are having some profit. So in addition, they have a tax. All these are there in the case study. So make sure that you know the you have keep this and the answer in front of you to know the figure. I'm not going back and showing you the figure. I hope you remember the figure. Okay. They have a 5 million of taxable temporary difference. Okay, this relates to same company and same authority. So that's why you can offset. You can offset when it is same taxable company and same tax authority. And they also expect 3 million of taxable temporary difference to reverse in 2008 and the remaining 2 million, because total 5, right? Out of that 5, 3 they expect to be reversed in 2008 and the other 2 million expect to reverse in 2009. Thus a deferred tax liability of 1.25. How 1.25? Tax rate is 25% and what is the taxable temporary difference is 5 million. On that you apply which is 1.25. It's a tax liability, deferred tax liability. This should be recognized and as a 3 million of taxable temporary difference are expected to reverse in the year. Make sure that you know what is this reverse. Okay. because the hardest part is this reversal part. I can understand the expressions you guys are having on your face right now. Deferred tax asset liability is easy. The hard part is reversal part. What is actually reversal? What happens when it's reversed? Okay, so let's see here now. The expected reverse in the year in which the deductible temporary difference reverses, right? So whole can also recognize a deferred tax asset. They can also recognize a deferred tax asset for 0.25, 25% on 3 million. Okay, that means they are having this 4.5. So out of this, they can use the 3 million of taxable temporary differences. So that means this 3 million can be set off against this. That means they can recognize deferred tax asset up to 3 million. So 3 into 25%, therefore deferred tax asset. Reverse means they are going to set it off against the taxable temporary difference, the deferred tax asset. Sorry, the deductible temporary difference. So the recognition of deferred tax asset for the rest of the deductible temporary difference will depend on whether the future. Remember, deferred deductible temporary difference was 4.5 already. Out of this 4.5, we have already set off 3 because we had a taxable temporary difference of 3. But what about the balance 1.5? There is still a deductible temporary difference left. So the rest of it will be depend on whether future taxable profit is sufficient enough to cover the reversal of this deductible temporary difference. Reversal means there will be no more deductible temporary difference. You will write it off against the taxable temporary difference. That is the meaning of reversal. So in the future, if you are expecting that you will have a taxable profit that will cover this 1.5, that means more than 1.5 is your taxable temporary difference in the future, you can set it off. You can reverse it. Okay. An entity is permitted to offset deferred tax asset and deferred tax liabilities if there is a legally enforceable right to offset the current tax against the current tax liabilities as the amount related to income tax levied by the same taxation authority on the same taxable entity. Make sure that you write this part because we have been offsetting. We cannot offset it like that unless certain rules are there. In this, we can because it is on the same taxable entity and the same taxation authority has levied this tax. That's why deferred tax asset and deferred tax liability we can offset against each other. Another condition is if it is they have a legally enforceable right to offset the current tax. And when can you say that they are legal enforceable right to do so? When they are in the same tax authority and the same taxable entity. Same like in this case. Because in this case it is like that, so you have to write this. Last paragraph, finally. What is it? After you apply the new tax law, what's happening? What is the impact on your financial statements? That's what you need to talk about. So after the amendment of the new tax law, that means 25% you are applying, right? When material, Holds should consider, what should they consider? Disclosing. You have to disclose it. Disclosing the anticipated current as well as the future impact on their results of operation, financial position, liquidity, capital resources. All these things you have to show your show the impact of the new tax law. So in addition, Hall should consider, what should they consider? Disclosure in the critical accounting estimate section of the management commentary. So you're bringing out the management commentary from your part A also because this is one company only, right? They should consider disclosure in the accounting estimates because these are some accounting estimates that you're using for the tax also. So you can add this new subheading like new title in your commentary known as critical accounting estimate section. So there, okay, in the management commentary. So there you can write this. The taxes, the tax rules and all, the new tax rate and all. To the extent that the changes could materially affect the existing assumptions used in making estimates of the tax related balances. If it materially changes your existing assumptions, make sure that you can write it. Okay. Changes in the tax laws and the rates may affect the recorded deferred tax asset and liability. Because if your tax rate changes, whatever you have currently recorded, it can materially change it. So better to disclose it. And also the effective tax rate in the future. It can affect all this. Okay. So definitely I can understand the nature of this question. This is a tough question, critical question. I can understand that it's not possible that most of you will get 14 out of 14 for this section, but at least some marks you can cover. For example, you can net it off against each other. You can talk about the nature of deferred tax asset, that you have to calculate deferred tax asset based on temporary difference. So these things you can write and get some marks. Try to collect some marks, okay? Because not every question is you can answer to your satisfaction. I can understand that, but so this is one of such question. Let us go to the marking guide. Okay, arguments for and against 4 marks. Okay, then discussion of understandability, relevance, and comparability is 3 marks, one mark for each, and 2 marks is applying this to the characteristics of management commentary. Okay, because it is more flexible, no content. Okay, part B. If you are explaining why taxable is different from accounting profit, you are getting 2 marks. So please don't miss this out. These things are easy marks that you can collect. Tax reconciliation, 4 marks. Tax rates, 3 marks. Deferred taxation rate, 5 marks. Definitely more areas will be on this area. Okay. And your professional marks, 2 professional marks. It's not that you will write 2 additional points and get the 2 professional marks. No, no, no. It depends on the way you are writing, the structure, how you are advising the investors. What are the things you are writing to disclose? For example, this you are referring to management commentary here. You see, so this is somewhere you can get the professional marks if you connect like this. So because this answers, if you are writing, for example, here critical accounting estimate section, you might get 1 professional mark here also, because these are some areas which is from your creative thinking. You have to be very creative also in SBR. Don't be like machines and robots that always try to use the, you know, whatever I have learned I will apply. You have to think also, some things you have to think beyond the textbook. Creative, be creative. These things are creative. Student who is thinking creatively only might be able to come up with something like this, or maybe you might be able to come up with more creative answers than this, something which is new. So don't restrict yourself to textbooks and all only, that if it's not there in the textbook, you have to find out your way to come out from that zone somehow or the other way, and try to give some creative answers like this by including this section. So for this you will get the professional marks. Okay, so that's it for this question. See you in the next question.